Hey everyone, welcome back to IMS Pro School's YouTube channel. Today we are diving into something super exciting, building a financial model from scratch on Excel. And not just any model, we are going to create a startup financial model step by step. If you are a beginner and always wondered how professionals forecast revenue, cost, and profits, this video is your perfect starting point. So grab your laptop, open your Excel, and let's start modeling. If you have ever wanted to understand how financial professionals build model and that drive the real business operations and how they understand whether this project will work or not, how they assess their worthiness, then today is the video for you. We'll break it down step by step for you, and by the end of this video, you'll get the hang of it. So let's start to model. So I hope you all have gone through the basic terminology of accounts, right? So we know what is balance sheet, what is income statement, and what is cash flow. So this is the structure how things work. So for an income statement, you always know what is revenue, then what is cost. For a balance sheet, you have to know what is asset, what is a balance sheet ratios like debtor turnover ratio, creditors ratio, and all those ratios. So once you get all those details with you, then of course you can make a income statement and a balance sheet. And out of those income statement and balance sheet, then you can draft a cash flow. This much you have studied in your school level also, right? So once you get the cash flow statement prepared, then comes the real step of the real world, how companies analyze that. So then we will estimate the cash flow for the companies and do the valuation. Of course, right now it must be seeming very heavy to you, but today we'll go right from the scratch level. When a business wants to make a startup model or enter into a venture, how they create their reports, right? So let's start. Okay. So I hope most of you must have thought about starting a business somewhere in the life, right? So when you want to start a business, various ideas comes into your mind. Sometimes it is like to start a restaurant chain. Sometimes it's to start say a bus service or a cab service where you have to work a little less. Others will be working for you, and you will be getting a good profit at the end of the month, right? So let's start from there. So suppose I travel from Delhi to Jaipur quite often, and I always find that the trains are a little messy, the flights are very costly, and the buses are not so good. So many a times it comes to my mind, why not I start a bus service to Jaipur? And it should be a little luxury bus, which give me a comfort of a flight, but at a lower cost, and of course with the flexible timings. And I can straight away go to the bus stand and just catch the bus to Jaipur, right? So let's start there. So when I want to start a bus service, right? So for a bus service, what do you think are the requirements? So when I think of a bus service, the first thing which come to my mind is that I have to buy a bus, right? A luxury bus. So suppose I think that my bus will cost me 1 crore, right? And the life of the bus will be, say, a decent 5 years. Okay. And then I will resell the bus and buy a new bus for the better experience of my customer. So that bus will be sold in say 20 lakhs. So that is a basic idea I have about my business. And of course, for easy purpose, I'm taking the deduction on the straight line basis. So in 5 years, it will be 20% every year, right? Now what? Now I need to know from where I will arrange the finance. Now, finance means कि पैसा आएगा कहाँ से? So the money can come from mainly two sources. Either it has to be my own money or I can take loan from the bank. So of course, since it's my new business, so I want to use the debt also. That what I hope most of you know that. Okay. So what is debt? Debt is all about loan. What loan we can take from the market so that some money is used from the loan side and the rest of the money I invest from my own savings, right? So let us say I am assuming a debt of say 14%, 40%. And say interest currently is on the business loan, say 16%. I have discussed with few of the banks, they are ready to provide me debt. Now the remaining part has to come from me. Now that remaining part can be called as say capital, or in more technical terms, it is called as equity. I'm sure most of you have heard the word capital. Capital is the money invested by the owner themselves. So that is also known as equity. Most of you must have seen the Shark Tank also, ना? तो equity बेच रहे हैं हम आपको अपनी. So that is equity. So now the first thing of financial model, try to type less and cell-referencing must be more. Now, what is cell-referencing? Cell-referencing means that once you change one cell, the other cell will change automatically. So, for example, here I have assumed that the debt will be 40%. So then my capital must be 60%. But suppose later on, when I actually start the business, the bank is ready to provide me 60% debt. Then my capital will be only 40%. So this adjustment must be made automatically. So what I can do is that instead of typing equity over here, I can use the formula equal to 1 minus my debt percentage. So this comes to 60. Now see, if I put debt as 70, equity automatically changes to 30. So I do not have to again type in every cell. Once I change one cell, the other cell will change automatically. This is one of the few nuances of the financial model which you must learn, right? And we completely take care of at Pro School about all these details, so that once you are into real life and making your model shall be very flexible. So if you like all these steps, you can of course join and subscribe our channel and hit the like button over here for more such videos, right? Let's proceed further. So once I have decided about the investment and the finance part, now comes the real thing from where the revenue will come, right? So let me assume that my revenue, of course, will come from the ticket price, right? So how many seats in my bus? So I assume that the price of my ticket, say, shall be, because it's a luxury bus, so I'm keeping the price at 2000, right? Then how many number of seats in the bus? So I do not want it to be too congested. So I'm just keeping, say, 30 seats. But of course, every single time the whole bus cannot be filled, right? Sometime it will be all 30 seats will be filled. Sometime only 10 seats are filled. Sometime 15 seats are filled. So we will take that the occupancy rate on an average will be, say, 50%. At least 50% of the bus will be filled every time. So sometimes it is 10%, sometimes it is 90%, but the average will be 50%. Now, how many days will I operate the bus? So working days in a year. So let us assume that out of 365 days, of course, one day I will keep a week off, right, for the driver also, and some holidays. So let us take 300 days in a year. Now, how many trips per day? So because Delhi Jaipur is say roughly around 6 hour drive, so I'm taking, say, 2 trips per day. That is one going from Delhi to Jaipur and then one coming back, and then at the night my driver will relax, right? So of course this is my revenue structure, but of course revenue will grow every year. Every year I will try to increase some part of my ticket price. So the growth in my revenue I have to assume. Let me assume a growth of, say, 5%. A very basic decent growth I am assuming, right? Of course later on, since we will be making a cell reference, so whenever we change one figure, others figure will change automatically. That we will see later on. So right now I am taking these basic assumptions. Now I have assumed about the revenue part. Now let us assume about the cost part. That is also important. So what are the costs? So of course, for running a bus, the basic first cost in my mind is fuel, right? So how much my fuel will cost? Say 100 per liter, right? Now, of course, then I have to take about the mileage. Since it's a luxury bus and 30 people will be traveling in it, so the mileage, let me take 5 km per hour per liter, right? That is my mileage. So, and how many kilometer I have to run? So the distance between Delhi Jaipur, for easy sake, I am taking, say, a round figure of 300 kilometers. Then fuel will not remain constant. Every time we know diesel and petrol are getting costlier and costlier. So there will be a growth, or we can say escalation in the cost of the fuel. So let us assume that cost of escalation can be 10% every year. Now, apart from this fuel cost, there will be other costs also. It could be driver, right? then it will be maintenance, right? Then it will be toll charges. So whenever we are making a model, we have to foresee what all cost can be there in the real life and what all revenue we can earn. So driver we have taken, maintenance we have taken, then toll charges we have taken. Then of course let's keep something for miscellaneous expenses like the repair charges. Sometimes of course the bus will break down in the middle. Then there will be some repair cost. Then driver might sometime overspeed. So there will be challans. So all those miscellaneous expenses we are taking into account, right? So everything we are taking trip wise. So driver cost, say, let us take how much? Let us take 3,000, right? Maintenance cost, let us take say 2,000. Toll charges, let us say take 1,500. Then miscellaneous. Now miscellaneous expense I cannot predict right now, but how business model work. So every businessman normally try to spend a portion of their revenue in the expenses, just like we do in our home also nowadays. So the way we earn our salary and the way our salary grow, we increase the maintenance of our home, right? So if we earn more, we say change our furniture. If we earn more, we buy a new TV. If we earn more, we repaint our house every 2 years. So it all depends on our revenue. So let us take 20% of my revenue as my miscellaneous cost. Okay. Okay. Now, will these all these costs will be constant? Of course not. So let me take the escalation cost of driver and maintenance to escalate at the rate of say 10% every year, right? Toll charges government do not change very frequently, so I'm not escalating that. And miscellaneous is based on revenue, so it will automatically escalate as my revenue increase. Now what do you mean by escalation? It's almost like inflation, how much it will increase every year that will take. So revenue I have taken, right? Cost I have taken, finance I have taken, investment. So for your easy purpose, let me highlight them for you so that you understand them better. So this is the investment part, this is finance, say this is revenue, and this is your cost part. So we have break down our all the things into four parts. So these four are the main pillars of a financial model, right? So revenue and cost will go into my profit loss account, and investment and finance will go into my balance sheet. That's how I start building my model. I hope everything is clear by now, right? So let us start building our model now. So once we are through with this assumptions part, so all this is assumption, of course, based on the market research, my own experiences, or maybe the experiences of the others from with whom I have discussed, who have done this business before me, right? And the suitable adjustments I have made. Now let us start making the model. So the first thing we have to make is, of course, the income statement, right? So income statement we will make. Then of course we'll make the balance sheet also, and then cash flow, right? So let us make the income statement. Now I hope everybody know the basic format of the income statement. Let us just revise that. So and on the at the top we will take the revenue. Then we will take, okay, slight spelling mistake. Let me correct this. Revenue. Then we will take the expenses part, right? And of course at the end we'll have a profit. Now comes the first and very important learning of a financial model. Whenever you are making a financial model, your year must start from zero, not from one. You'll understand this later on. Why? See, because whenever you are making an investment, the money is going today. Accounts start from first year. Why? Because in accounts we prepare the balance sheets and income statement at the end of the year. So that is called the year one. But in finance, we have to calculate not only the profit but also the flow of cash. So finance is largely based on cash, not the profit part. So we will start always with year zero in the finance. That is the time when we are really investing our money, which is today. So we'll start with year zero. then of course it will be year 1, year 2, 3, 4, and 5, because we have assumed that our bus will run for 5 years. So we are forecasting this 5-year project. Now, how will I calculate my revenue? Of course, in the 0 year, there will be no revenue. It will start from year 1 only. Now comes the main part. Now we will do not type anything. We will do the cell referencing, so that whenever I want to change any of my assumptions, my model figures automatically changes. So how will I calculate my revenue? My revenue will be the price of my ticket, right, multiplied by the number of seats, multiplied by the occupancy rate, multiplied by the number of days, and then multiplied by the number of trips in a day. Do you agree? Let me just break it down for you. So I have 30 seats in the bus, right? Out of those 30, only 50% will be filled. So 15, so 30 into 15%. Then one seat will give me a revenue of 2000. So I have to multiply price with the quantity, right? Now this is for just one trip. I am doing 2 trips in a day. So multiply by 2. And now this is for 1 day. Then I am doing it for 300 days in a year. So models are not made day wise. Models are always made for a year. So this is how I will break up my formula. What? My price of the ticket, number of seats, occupancy rate, number of days, and number of trips. So this is how I will calculate my revenue. Now comes the second learning. Whenever we are making a model on an Excel, we know we will use the tricks of Excel also. Now in Excel, normally when we have to make model for 2 year, 3 year, 4 year, or 5 year, we will be dragging that, right? So suppose I drag it now, you can see everything is an error. Why? Because when I drag, Excel will, instead of taking these cells as reference, will take their next part as reference, right? See here. Here it has taken the C column. Then here it has taken the D column. Then E column, and then F column. So this is one of the biggest and serious mistake normally person can do. So what we have to do, either we can freeze these cells, so that when we drag, it does not change. But I want to change it. Why? Because there is a growth of 5%. So I am not freezing it, but instead of dragging, I am using the compound interest formula. Now, what is the formula? So I'm sure all of you must have heard about this formula, that principal into 1 plus r to the power n. Most of us have studied, or all of us have studied this formula in around 5th or 6th class, right? The formula for the amount, that if I invest 100 rupee today at a rate of say 10%, how much it will grow to next year. So we will use the same formula and find the revenue of the next year. So the next year revenue will be current year revenue multiplied by bracket start 1 plus the growth rate and power to 1, because we are taking only the 1 year growth. But since this growth rate will be constant year after year, year after year, so anything which has to be remain constant shall be freezed. This is the trick of Excel. So we will freeze it either by pressing F4 on your keyboard, or function and F4 key on your keyboard. There is a dollar sign. So when you see this dollar sign both in the cell and the row, it means the cell and the row are freezed. So see, now this revenue I have taken for first year. The second year revenue is calculated 5% more than this revenue. So how much is this revenue? See this. This is 1 crore 80 lakhs, and this is how much? This is 1 crore 89 lakhs. So 9 lakh revenue is increased because of the increase of 5%. Right? Let us follow the same trend for the next year. So now we can simply drag it and it will automatically change the figures. So when you see this hash sign in the Excel, it means that your cell is smaller and the figure is bigger. So don't worry. Just select the column and double click at the edge. So it will automatically adjust the size of the column as per the figure. So now I have the figure from the first year till the fifth year, how my revenue will grow year after year. Work like a magic, and that's the power of Excel. So if you want to learn more such tricks, you can of course hit our channel like button and subscribe to this. We keep on coming up with such nice videos on Excel as well as other tools which help you build up these financial models. So once I have taken the revenue, I have to see, is there any other revenue of the company? No. So this is the only revenue my company is earning. Now let me take up with the expense part. Now I see I have two lines over here. So these are extra for me. So I can cut down those lines by simply deleting the rows, right? And now take the expense part. Now in expenses, my expenses are, the first expense is fuel cost. So let me take the fuel cost. Then the second one is driver cost. So I will take the driver cost. Then maintenance. Then miscellaneous. And then toll charges, right? So I have cut down all the costs over here. Of course, there is interest, but we will take that later on. First, we will take up the basic operational cost of my business. So how much is my fuel cost? Now, this is a basic level maths. So see, my fuel cost is 100. Mileage is 5. That means in 100 rupee of petrol, I can drive 5 kilometer. That means for 1 kilometer, the cost will be 20. As simple as that. What I have done, equal to my fuel divided by my mileage. It will give me the cost per liter. So I will use this simple maths formula to calculate my total cost of the fuel. See here, equal to the cost of the fuel divided by the mileage. It will give me the cost for 1 kilometer. Now, how many kilometer I am driving? I am driving 300 kilometer in a trip. Now, how many trip I am making? I am making 2 trips. And how many days in a year? 300 days in a year. So what shall be my total cost? My total fuel cost shall be 36 lakhs. Are we getting it? So my total fuel cost shall be 36 lakhs. I can just simply reduce the zeros over here. Right. Now, you can ask me that why I have not freeze this, because fuel cost will be same, mileage will be same, distance will be same. But see the fine line over here. The fuel cost is not same. It is increasing year after year by 10%. So instead of freezing it, what I have done is that I have not freezed it. Now next year fuel cost shall be the previous year cost into same formula, bracket start 1 plus my escalation. So the same amount formula I am using. Now escalation is 10%, but it will remain same for the 5 years. So I have to freeze it. So my next year cost will be 39 lakh 60,000, right? And now simply I can drag it. And if I want to use the comma over here, I can use the comma so that my figures are more reading friendly, right? So the cost of last year fuel will be 52 lakh 70,760. You can always check these formulas initially when you are building the first model and you are not very confident about Excel or how this dragging work. You can always cross check these figures on a calculator to make you more confident. Okay. Now, what if I tell you the toughest part of the model is already done? Because we have now come into the middle of the model. Now we know how things are working. We have learned the basic of financial model steps, that it is start from year 0, how we have to drag, how we have to freeze the cells, how we have to use the cell referencing, right? Now we have to apply the same techniques for all other things. So the driver cost. Now, what is the driver cost? My driver charged me 3,000 into how many trips? 2 trips. Into how many days? 300 days. So my driver charged me 3,000 into 2 into working days. So the driver cost will be how much? 18 lakhs, right? Now, there is a catch over here. The driver cost is increasing by 10% every year. So again, the same formula equal to the previous year driver cost into bracket start 1 plus the escalation part, freeze the escalation, close the bracket and simply enter. So the next year driver cost will be how much? 19 lakh 80,000. And simply now I can drag it further for all the years, right? Same goes for the maintenance. Now the maintenance cost is 2,000 into 2 trips into 300 working days, right? So the cost will be 12 lakhs. Again, it is also escalating. So equal to first year multiplied by bracket start 1 plus the escalation part and freeze it, multiply, enter and simply drag it. So what you have to understand is these two things. One, self-referencing and the other is when to freeze and when not to freeze. Apart from that, one basic formula of finance of the amount, which is compound interest, comes into picture everywhere. That is principal into bracket start 1 plus rate of growth bracket close to the power for how many years you want that growth, right? Now we come to the next cost, which is miscellaneous. Now the miscellaneous cost is how much? It is 20%. Now, do you think this 20% will change every year? No. So we will freeze it. So whenever you are making a cell referencing, always for each cell, just think for 2 seconds whether you have to freeze it or not to freeze it. Now I am freezing this 20% and linking it with my revenue because it is 20% of my revenue. But revenue will keep changing every year. So I will not freeze this cell D21 and my first year miscellaneous cost will be 36 lakhs and I will simply drag it because every year my revenue will keep changing and accordingly my miscellaneous cost will keep changing. Got it? Okay, great. So we are so far so good, right? So for building a financial model, you need to have just two things. One, of course, your accounts and finance basics must be good. And the second part is Excel. You must be good with Excel tricks and tools. And for both of them, we have multiple videos on our channel. We keep on adding those as per the new tricks. So just follow us for more such videos and you will get a basics of also covered over there. So now let's proceed. So toll charges. So toll charges are 1500. Now comes the catch over here. There is no mention that toll charges will increase year after year. Since it is not increasing, so we have to freeze it over here and then multiply with the number of trips. It is also not changing. So freeze into number of days. It is also not changing. So just freeze it. So 90 toll cost will be 9 lakh per year. And now see the magic of Excel. When you are dragging it, it is not changing. Why? Because we have freezed all the cells. So this small basics of Excel are very important to build a financial model. Now we have calculated all the expenses. So here we can calculate our total expenses or total cost, right? Simple. Use the formula of sum and add all the expenses over here and simply drag it. Now, when we subtract all expenses from revenue, we come to the figure called EBITDA, right? Earning before interest, tax, and depreciation and amortization. So this is a very important term used in the business circle. So normally in the school or college level, you have heard the word profit. But what profit? The profit could be after tax, before tax. Profit could be before interest, after interest. Similarly, the profit before depreciation is a very important benchmark for any company to check how they are growing. because depreciation is one such expense we know which is very, very huge in amount. But one also fact remains very important is that it is a non-cash expenditure. That is, we do not pay anything to write depreciation in our books of accounts, right? So first we will calculate EBITDA. How? Simple. My revenue minus my total expenditure will give me the figure of EBITDA 69 lakhs. Now, if I drag this figure, I get the EBITDA of every year. Now, from EBITDA, the next thing I have to subtract is my depreciation. So less depreciation. Now, I hope everybody knows the formula for depreciation. So there are two possibilities. Either we can simply use the basic logic. My bus was of 1 crore, right? And my resale cost is 20 lakh and divide by 5. There is a basic formula I can use for the depreciation. Or if the rate is given, then I can use the rate also. So either of the two will be given to you, either the rate or the straight line method. So let us use the basic over here first. See, so what will be my depreciation? So my depreciation will be equal to, bracket start, the cost of my bus minus the scrap value and divide by life. 16 lakh. Do you think this depreciation will change year after year? Yes, it can. If the method I follow is of written down value method. But I have assumed the straight line. So this depreciation will not change year after year. So what I have to do is, when I am using the formula, I have to freeze each and every cell over here, so that when I drag it, my figures do not change year after year. See this. Now when I drag it, the figures will not change. Right? So this is the best part of Excel. I always say to my students that once you understand freezing and dragging part now, things become much easier for you. Okay. So once I calculate my EBITDA, so now and deduction, now I can have a figure of EBIT. That is my earning before interest, which is equal to my EBITDA minus the interest part or deduction part. So this gives me the figure for EBIT. Okay. So now the last expense, that is interest, because I have taken the loan. So there will be interest. Now, how much is the interest part? So the interest is 16% and it will remain same. So I will freeze it. Also, the interest will always be on the loan. So how much is the loan? 40%. Freeze. 40% of what? 40% of the cost of my bus, right? So 66 lakh 40,000 will be my interest per year. And since everything is freezed, so I can simply drag and my, okay, the cost of bus I forgot to freeze. So I will freeze it first and then drag. So these kind of mistakes you will do in the beginning. And once you are through to it, you understand how things work by freezing or not freezing a cell. So my interest is 6,40,000 per year. And now I will come with the figure of profit before tax. How? If I subtract from my earning before interest and tax, the figure of interest, I will get the figure of profit before tax. And now comes the tax, the most important aspect. How can I forget the tax which government levy to us? Okay, we have not taken any assumption for our tax. So going by the current scenario, let us take, say, tax at 30%. Okay. Right? Say, let us take it 30%. Okay. So my tax will be equal to my profit into the 30% part. Now this 30% will remain year after year same. So I will freeze it. And my tax will be 13,98,000. And then I can take profit after tax, which will be profit before tax minus equal to profit before tax minus the tax. So 32,62,000 is my profit for the first year. Finally get to see some interesting figure, right? Which is more interesting. So what we can do in Excel is that if the formulas are put properly, we can take 3 rows together and drag them. The answer will be same. So we can drag 3 rows or 4 rows in one go also. So now this profit is my main figure which I need. So I will just highlight this figure, right, for you. So I have come up with the figure of profit. My first basic hurdle is crossed. And let me tell you, with my experience of financial modeling for over around 10-15 years now, that when we build a financial model, this is the toughest part. Why? Because to forecast your revenue and to forecast your cost is the main thing. If you have done that rightly, most of the time your assumptions will work and your model will give you a clear picture of your business, right? The remaining part is much easier. For example, now what is the next part? The next part is to make a balance sheet right now. So see, in our model, the balance sheet is very simple. I have just one asset, which is bus. I have just two things on my liability side, my debt and my capital. So even in this question, because the balance sheet is so small, because we are running just as a service sector, and services for a bus, we are just skipping the balance sheet part because it is easy. We will cover up that in some other video maybe for you. So just keep following our channel for that and you will get to know about other steps also. Today our focus is that not to overwhelm you with too much of knowledge, too much of jargons, just to give you a glimpse of how financial model work. So instead of making a balance sheet, I am directly uh, going to the free cash flow part. So the free cash flow to equity part. Now, how we calculate the free cash flow to equity? This is very interesting. Let me just show you one basic first. I'm sure you must have seen in your cash flow that there are three kind of activity: cash from operating activity, cash from investing activity, and cash from financing activity, right? In operating activity, we take things like salary, revenue, say operating expenses, all those things come in our operating activity. In investing activity, we take our non-current assets, purchase and sale. In the financing activity, we take our debt and equity. Now, since I am evaluating my business, so if I want to evaluate how much return I will get, I must keep my figure out of the calculation, right? So what we will do when we take the free cash flow, so free cash flow is nothing but we will add up the cash from operating activity, then cash from investing activity. It could be plus, it could be minus. And then we will take what? We'll take the cash from financing activity, only the debt portion. So this is very interesting, right? So when you calculate the FCFE, you do not take the equity part to it. Why? Because we are calculating or evaluating the model for us only. So how can our own investment can be included in that, right? So what we'll do is we'll keep the equity part out of it. So let us calculate this. Now FCFE. So these things need to be calculated. Now I'm sure most of you know how to calculate the CFO. If not, let me just revise for you. So to calculate the CFO, we will first take the PAT. Now what is PAT? Just simply copy from here, right? In the PAT, we will add all the non-cash expenses and non-operating expenses. I'm sure this you must have studied at your school level. If not, then you can see our other videos in which we explain all these basic concepts also. So we will add. Now, what is the non-cash expense over here? Only depreciation. So what I will do, I will simply copy depreciation from here. So my depreciation will be added. Then we make the adjustments for the working capital, but there is no working capital given in the assumption. So these two figures will give me my cash from operations. So the first part is done. Now the second part is cash from investment activity. So what I will do is I will take the cash from investment activity. Now comes the interesting part. So if my balance sheet was made, I can take it the figure directly from there. Otherwise, I have to just think where my money is being invested or being recovered. So you must remember that we have purchased a bus for 1 crore and we have decided that after 5 years we will sell the bus for 20 lakh. So that means in the year 0, now comes the important part. Now 0 year will come into picture. Why? Because I am purchasing my bus not in the year 1, not at the end of the year. I am purchasing it in the beginning of the year. And the profit loss figures which we have taken are the end figures. So the investment part, that is CFI, I have to take, we call it as capex. If you have not heard this word, let me clear this word to you. This is called capital expenditure. So whatever expenditure you make on your non-current asset is called capex. So when you purchase an asset, cash goes out. And when you sell the asset, the cash comes in. So in the year 0, what we are doing is we are investing in the bus. So 1 crore, but the cash is going out. So instead of writing 1 crore, we will use the formula equal to minus of my bus cost. Simple. So the money is going out. We are giving this direction to Excel that the money is going out. In the year 5, the money will flow in. So equal to, and this 20 lakh will flow back to me in the year 5. Right? And the last part, now we come with CFF, that is the debt part. Have we taken any loan from the market? Yes. How much? 40%, if you remember. So we will write equal to 40% multiplied by the cost of the bus. Simple. So 40 lakh. Now, shall this be in plus or in minus? Anybody of you can guess just. So we are taking a loan. So since we are taking a loan, the money is flowing into the business. So we will take up this figure in a positive way. Then after 5 years, we will repay the loan. So in the 5th year, this money will flow out of the business. So we'll take minus of the same figure in the last year. Now, in the real life, loan can be paid in installments also. Loan can be paid in the EMI format also, or loan can be paid in the lump sum also. So since this is a very first business we are starting, so we are taking the basic level. That is, we have taken a loan in the beginning, and once our project is completed, we will repay the loan for the bank. So this is how we have calculated our cash flow figures. Now, we simply calculate our FCFE, free cash flow to equity, by adding all these figures, what we have calculated over here. So simply add these figures and you will get the cash flow for your company for the next 5 years. So in the first 0 year, cash is flowing out. First year, second year, third year, fourth year, and fifth year, we are seeing the positive flows, right? So this tells me the whole picture of the forecast for the next 5 years of my business. So you see, in just half an hour time or even less than that, how a financial model is being built of a bus service, luxury bus service, which we are going to run from Delhi to Jaipur. So this is how financial models are built, and we make this project report and pitch to the investors if we have to go there. So for example, you will going to the bank also to apply for the loan. Bank will also ask you about the projections, where your profit will come, where your profit will be invested, how much cash you will generate every year. But all these are the absolute figures. Now, bank want from you the absolute figure as well as a figure in percentage. How much return your business will be generating. So all of you must have heard of very famous term in the market called ROI, return on investment. Now, ROI is a very accounting term. In the accounting, we calculate the return based on profit. But in the finance field, we calculate the returns based largely on cash. So in here we call it as IRR, internal rate of return. That is how much this project is generating for me. Now, to calculate the IRR, I simply have to use a technique of Excel IRR, and Excel asks me the values. As Excel is asking me what are the values for 5-6 years you are generating. I will just select those values and enter, and I'll get 75%. So this tells me with certain assumptions that my model, this which I have built and forecasted, is giving me a return of 75%. Now, whether I shall accept this or not will always depend on my benchmark. So that benchmark in finance is normally called as weighted average cost of capital. But in case here we are calculating for equity, so it will be called as cost of equity. Now, cost of equity will always be based on the risk analysis of the investor. So if my investors see that this is a risky business, their expectation from me will be high. If they see this business to be less risky, their expectation will be a little less. So since here we have taken the interest on loan at 16%, so let me take the cost of equity to be say 30%. So my investors have told me that you have to give us the return at least 30%. Or maybe if whole money I have invested myself, I have set a benchmark for myself that at least 30% I have to earn. Now, the project is giving me a return of 75%. So if the return expected is 30% and the return generated is 75%, then definitely it is a worthy project to enter into. See, in just 20-25 minutes of time, we have taken a decision whether we want to start this business or not. So this is the beauty of financial model. So if you want to learn more about the financial model, just follow us for more such videos. We'll come up with more model, more moderate and complex model also. Where we'll teach you how to make a balance sheet also, how to make a cash flow statement also, and make more delicate or more technical assumptions about the model. And also will teach you once these assumptions are changed, how my whole model will change. Let me give you just one last idea of it. Suppose the bank tells me that why are you taking a loan of 40%? We are ready to finance your project for 70%. Now suppose I take a loan of 70% over here. By just changing one figure, you will see my whole calculation changes, right? So I do not have to change each and every figure because I've used the cell referencing very beautifully. So my IRR automatically changes. Again, if my bank says we will finance you only 20%, so you can see that my IRR changes to 57%. So I can forecast various scenarios for myself. And with the help of various other tools of Excel, we'll teach you in the next videos how we can put up these scenarios in a summary format for our investors to judge which option we shall choose. So this is just a glimpse into the world of financial modeling. If you want to master the financial modeling topic by topic in detail, join ProSchool's financial modeling course where we cover everything hands-on from Excel basics to advanced valuation models. So don't forget, if you found this helpful, hit the like button, subscribe to our channel and turn on the bell icon so you do not miss any important upcoming lessons or other updates. And see you in the next session. Thank you.